episode of Beyond the Barrel. Today I'm joined by Ben Lockyer. Ben's come back over from our Middle East business unit to discuss a couple of key topics in the industry that are happening this week. Please don't forget to follow, like, share and subscribe our channels. All of our Beyond the Barrels now are on all social media platforms, from Spotify, Apple Music, Amazon Podcasts, all the way to YouTube, Instagram, Facebook and LinkedIn. Please do follow on your preferred channel. It helps us grow. And let's get into today's topics. This week we're going to be looking at the sharp decline of the oil price. Last week I posted out a video analysing the trading charts showing that oil could have reached $67 with an anticipated projection of 64 and a bit by the end of the week, which it actually reached. But today we're going to be discussing the root causes and analysis of why the prices have gone steeply off a cliff. So Ben, I'm just having a quick flick through some of the key oil stories this morning, and what I'm seeing is that Saudi Arabia have pushed out to the market that they are officially going to be slashing prices by $2.3 per barrel on their flagship product, which is Arab Light, for May, which is just around the corner now. This seems to be very much off the back of the new tariff announcements that Trump's bringing to the market. What have you seen in terms of price-driven activity off the back of these new tariffs?
So as we've seen over the past week, Trump has imposed tariffs on a lot of countries, causing uncertainty in the market. This has obviously caused fear in the likes of Saudi Arabia, who are the biggest oil producer, which has caused prices to come down.
I think one of the things that really strikes me is every time that Trump comes into power, things like this happen. This isn't unusual. But what I've read from the stories in the market this morning is that as soon as the US applied these tariffs to oil products, and especially to China, which is the world's largest oil importer, they immediately responded with their own tariffs, which has then caused a knock-on effect to OPEC Plus, saying that they're actually going to stop production cuts and actually increase production by 3 times the value, which is obviously having a massive impact on the oversupply to an under-demanding market. I think this is a very clear indication as to why these developments in the oil price have absolutely plummeted over the last couple of days.
I think another main reason for the oil prices coming down is the strong supply from non-OPEC producers like the US with their Permian Basin, which is a big oil producer, and that's going to be ramping up with Trump bringing in this drill baby drill to open up oil and gas in America, because he wants them to be the leading oil and gas producers once again. And then also Canada ramping up production, Brazil and Guyana as well. So these non-OPEC producers are going to have a huge impact on oil and gas pricing moving forward this year.
So this morning our prices, as we're filming this on the 8th of April, WTI crude 61.27, Brent 64.75, natural gas 3.678. It's a massive $10 drop off since the last time I filmed this kind of call out, which was a week ago. The other parts where we're seeing a massive impact from these tariffs are the oil field services sector of the industry, where they were already seeing massive impacts from the additional 25% tariffs on aluminium and steel, not only from a price and profitability point of view, but also from a long lead item point of view. We've just come out of another downturn, a pandemic, you name it, we've been through it. And now we've got more price constraints, more price tension, now a even possible and even larger shortage of supply of raw materials that are needed to keep this industry moving. It's almost like this has been done to impact the industry in a way that it stops people producing rather than overproducing. But at the same time, we're in a very much a downward spiral now of oil price. I've seen some news stories that people think it's going to go back down to $50 by the end of the year, which is highly concerning because deep water assets cannot operate at $50. Not many places can. And is Trump trying to target $50 because they know they can?
I think it's quite interesting what you're saying. I think the main reason Trump is doing this is to bring down interest rates, especially in the US, because the US are in a lot of debt at the moment. I think he's really trying to target the interest rates because since he's come into power, he's really trying to promote supporting the middle class, and by bringing down interest rates, we'll support that. And I think in a way, he's probably trying to crash the market to bring down them rates,
Yeah.
which is having an implode globally with all of these tariffs that he's putting in. So he can get better trade deals from these countries, but it's a huge risk because if these countries do not, if they do not come to the table to negotiate, then there's just going to be back and forward on trade wars, just like you're seeing with China at the moment. So it's a huge risk he's taking, and it would be interesting to see how it's going to impact the market this year.
Yeah.
Another issue that could be affecting the oil price is Russia not agreeing to production cuts, as they are a part of OPEC Plus. So with Russia not agreeing to production cuts, is also going to add to the oversupply of oil.
Yeah. The other part and the other news stories that I'm seeing around the world in all industries is that Reuters and other financial news institutions are predicting a 45% chance of the US sliding into recession this year. We all know that when a global powerhouse like the US slides into recession, it dramatically falls downhill. The UK typically follows a year later. And that directly impacts oversupply and demand of oil products, because falling into recession usually results in an oversupplied market. So with countries like Saudi, China, Russia, all saying that they're going to triple output, with us coming into a recession, could have a double effect on the market where we're sliding backwards but also boosting production. I mean, the people that are playing these games, if you like, are far more educated than we are and far more knowledgeable on what they're trying to achieve. But it just seems like our industry can't get a break. We've been in five downturns now in 10 years, for a global pandemic in the mix as well. When are we just going to get 2-3 solid years of trading again? It's really hard. So another part of our discussions as a business, obviously being in the manpower space, is looking at the trends between ramping up, slowing down, full-time hire versus contract hire. I know we're bringing some new solutions to the market over the next couple of weeks, which are a hybrid of all of that and are unique to the industry, which will hopefully give our customers some stability. But from a typical contract versus full-time hire model in the industry, we've seen a massive shift towards customers wanting to hire full-time, especially in the likes of Saudi, where there is a massive demand. What's your view on this being impacted now we're seeing the oil price go the opposite way?
Well, typically, oil and gas companies, service companies, oil companies, they want to hire full-time when they see stability in the market, right? Yeah, by seeing stability in the market, it means that they will look to switch to full-time models rather than contracting. But as the market becomes more uncertain, they may go back to a contract model because they're not that confident in where the market's going, which will see a huge uplift on service companies and operators going back to the contracted model.
Yeah, I completely agree. I think every time that we go into an unstable market, should we say, contracting is obviously the go-to. It gives customers the flexibility to ramp up, slow down overnight without having the added pressure of employment rights and so on and so forth. But we also see day rates absolutely go off a cliff sometimes when this happens. And we've never recovered. We've never recovered from the 2013, 2014 prices in the market. We were just getting back to somewhere like, 60% of that this year or back into last year. And my fears are we're going to slide back down that chain to bottom pile rates if we continue, which is going to drive an even bigger factor of even more people leaving this industry. We had loads of the kind of more senior, knowledgeable guys leave in 2015. then another batch of mid-tier and seniors leaving 2019 when COVID hit, to 2020, 2021. We saw a couple come back, but it was kind of their last hurrah. If these prices go down, why would someone come out of retirement if it wasn't financially beneficial? And it's certainly not going to attract the newer people into the industry. They're going to go to alternatives, AI, IT.
They're going to go to more stable markets, right?
Yeah.
Markets that aren't affected by factors that happen.
I think every market has the ability to be impacted to some degree, but where we've got growing demands of AI, data centres, IT infrastructure, renewables to a degree, whether that's working or not working is a different topic altogether. But, there is a question mark. Why would someone get into this industry if it keeps doing this? We've got to find as an industry some stability to entice the younger generations to continue with what we're doing.
So the other factor is the clean energy net zero that the UK are really, really big in. That could impact the oil and gas market hugely. Like with other countries like France, also put a lot of money into net zero. As these countries start integrating into green policies, it could start seeing a real big shift towards the downfall of oil and gas.
Especially with the instability that we're seeing within the industry. I think everybody thought we were back for a few years. Rig prices were on the rise. Utilisation was going back up. Let's just hope that this doesn't turn us into another downward spiral. Natural gas is still looking very strong. These data centres and so on still require massive amounts of natural gas, LNG and so on. So I think there is a big opportunity in that market, but oil is still once again looking very, very unstable.
And also electric cars, that burst onto the scene at one point, and now that's sort of taken a little bit of it's a sort of lost momentum.
Yeah, 100%. And a lot of bigger manufacturers, BMW, Porsche is another one that have said that by X date they're no longer going to produce electric vehicles. They're moving to hydrogen molecules as an alternative energy source. Unfortunately, even I was on the back end of seeing that news hit the market with buying an electric car. A couple of years ago, it lost 65% of its value in year one. That's not a sustainable market.
No.
If people are going out there to buy electric cars because it makes a benefit to the company or to support policies, and then they're losing 65% of their cash in year one, no one's buying a new electric car.
No.
You can pick up second-hand, unbelievable used vehicles now at like half the value that somebody else did the year before.
And it's like these industries bringing in electric cars, they've tried to run before they can walk. The infrastructure in the UK isn't in place for these electric cars. There's not enough charge points. People haven't paid for charge points in their houses. But because the infrastructure isn't there, it's really turning people off going down the electric car route.
The infrastructure, the price, the oversupply to what seems like an industry that's going back to fossil fuels. It's all good for the oil and gas sector, but you have got multiple things going on here at once. Let's just hope these tariffs slow down soon and it's just Trump playing his usual games. So look, appreciate everyone joining the Beyond the Barrel podcast this morning to review the oil price. We'll keep you up to date as we see new developments in the market. Thanks very much. Tune back in soon. Please don't forget to follow, like and subscribe.